All right, so we're looking at the capital asset pricing model. All right, this shows the relationship between the level of risk, all right, relationship between the level of risk, which is found in our x-axis, all right, and the required rate of return. Okay, so CAPM shows the relationship between the level of risk and the required rate of return. And the level of risk is measured by the beta coefficient. Okay, if we remember the formula for CAPM, right, it's the risk-free rate. All right, this is the profit or interest you get for investing in an investment that is risk-free. All right, example of risk-free investments are government securities. All right, we have treasury bills which mature after 1 year. We've got treasury notes that mature between 2 to 10 years, and we've got treasury bonds that mature between 20 to 30 years. All right. Plus beta. All right. Beta, this measures the level of systematic risk. Systematic risk, this is the risk that affects the market as a whole. All right. Then open brackets, the return on the market portfolio. All right, the return of the market portfolio is just the expected return of the stock market as a whole. All right, the expected return of the whole market, that's what rn is, minus the risk-free rate. All right, this is what we call, so this, what we have in brackets here, is what we call the equity premium. All right. This is the extra return for investors in riskier investments. All right. When you choose to invest in a riskier investment than a government security, which is risk free, all right, you're going to get extra returns. All right. So we can look at our graph here. All right. Our risk-free rate is here on our y-axis. Let's say, for example, if you invest in a government security, which has a risk-free rate of 5%, right, your expected return will just be 5%, all right? But if you say, okay, you want to invest in something else apart from a government security, which involves more risk, all right, like shares, preferred shares, all right, you're going to get an extra return. As you can see, we have an upward sloping line here, all right. This upward sloping line, what it is representing is the higher the level of risk on an investment, all right, the higher the level of risk, the more the return. Okay, the higher the level of risk, the more the return. That's why we have an upward sloping line. All right, and then as you can see, the difference between the upward sloping line and this straight line of the risk-free rate represents the equity premium. All right, the equity premium. Okay, the extra returns you get for investing in an investment other than an investment that is risk free. All right. So, as the level of risk increases, as you can see, starting from the risk free rate, let's say, for example, let's say we have a point here. Okay. So we say we have point A. All right. And let's say it's got a beta coefficient of 0.5. All right, 0.5. Let's see what we're going to expect as our rate of return. All right, so we just use this formula. Okay, we say the risk-free rate is 5%. All right, the risk-free rate is 5%. Okay, let's also say the return of the market, RM. Let me just put this. The return on the market, all right, the expected return of the market as a whole, let's say it's 11%, all right. Okay, so now let's compare. All right, we've got investment A, it's got a beta of 0.5. Okay, the return on the market is 11% minus the risk-free rate 5. All right, so let's just do this little calculation here. 11 minus 5, that is 6. All right, 6 times 0.5, that is 3. So 5% plus 3%, we're going to get 8%. All right. So the expected return on this investment, which has a beta of 0.5, is 8%. Okay. So as you can see, the equity premium, okay, is 3%. The equity premium is, what's this? 3%. I mean, not 3%, 6%. All right. 11 minus 5, that's 6%. Okay. So here what we can see is that if we invest in a risky investment than something that is risk free, we'll get a higher return. So here we get a return of 8%. Okay, let's see if the beta is let's say, let's give the investment a beta of 2. Okay, we give it a beta of 2. All right. So here we say point B. All right, we give it a beta of 2. All right, so the risk-free rate is 5% plus our beta is 2. All right, our equity premium 11 minus 5. All right, 11 minus 5, the equity premium is 6%. All right. All right, 2 times 6, that is 12. All right, 12 plus 5, that is 17%. Okay, that is 17%. All right, so the required rate of return of this investment, which has a beta of 2, okay, this can be a share, this can be a bond, this can be a preferred share, all right? The required rate of return, all right, of this investment, which has a beta of 2, is 17%. Okay, so as you can see, the higher the risk, all right, the higher the required rate of return. Okay, so that's basically the relationship that I'm trying to show here. All right, then we can also use this graph, okay, to to be able to see if stocks are undervalued or overvalued. Okay, this upward sloping line is also called the security market line. Okay, this upward sloping line. Okay, it is called the security market line. Okay, so if we have, let's say, a stock which is above the security market line, all right, we say it is overvalued. All right, and if we have a stock below the security market line, we're going to say it's, I mean, this one above the security market line is undervalued. Sorry. Undervalued. Okay, it's undervalued. And
Why is it undervalued, Abdullah?
because it is selling at a price below its true value. Okay, it's selling at a price below its true value. Okay, then below it's overvalued. All right, it is overvalued. Okay, so when you plot the security market line, all right, and you see a point below, it is overvalued, meaning that it is priced at a higher value than its true value. All right, then above the security market line, it's undervalued, meaning it is selling at a price below its true value. Okay, because the reasoning behind that is, all right, the reason behind it is because they're saying that, okay, the level of risk is too low for the required rate of return for let's say an undervalued stock. Okay, the level of risk is too low, okay, for the required rate of return. So that's why it's undervalued. And for some that's overvalued, all right, the level of risk is too high for the required rate of return. Okay, the level of risk is too high for the required rate of return. Okay,